Hi guys, Brendan here. I'd like to start off with a quote from William Bernstein. He's a financial theorist and his research is focused on modern portfolio theory. He also wrote the book The Four Pillars of Investing. He said, "There are two kinds of investors, be they large or small, those who don't know where the market is headed and those who don't know they don't know." I've been hearing a lot of chatter about the current market environment being a bull trap. Now, a bull trap is where there's a dip in the market, we have a recovery, it looks like the recovery is going to continue, and then there's another dip. So if you thought about this, how that would look on a chart, it looks more like a W rather than just a V recovery. And while this may happen and the market may follow that pattern, the truth is that no one really knows. This is just another form of timing the market. And that's what we're going to talk about today. We're going to discuss why you shouldn't time the market and how to get over that psychological feeling of wanting to and feeling like you can time the market. And make sure you stick around until the end because we'll go over some real world examples and show how timing the market can hurt you. If this is your first time here, thanks for joining me. The goal of this channel is to help you reach financial independence and give you the option to retire early. And we do this by going over current affairs in the world of finance and give you tips to help you invest in the market. If you find value in this video, please hit the like button and subscribe. Now let's jump into it. So to start off, what exactly does it mean to try and time the market? Well, it's a strategy where an investor buys and sells stocks in the market based on their expectation of market fluctuations. If an investor can correctly guess which way the market's going to move, then they can make corresponding moves in their investment portfolio to take advantage of that. While this is great in theory, it's seemingly impossible to make work on a consistent basis. Some investors may hit it right every once in a while, but earning profits repeatedly over a period of time is really a pipe dream for most. And this is because it really is just guessing or betting. In theory, it makes sense that someone should be able to look at fundamentals within the market and then predict how the market will react. But this assumes that the markets are rational, when in reality they are anything but. You may still think you can beat the market by perfectly balancing technical and fundamental analysis. But just because the market is made up of numbers doesn't mean that it moves based on those numbers. Well, not entirely anyway. So why do stocks go up and down? At the end of the day, it's based on human investors. Greedy, emotional, fearful human investors who react to the news of the day and send the markets either soaring or spiraling downward. Apply all the logic and formulas and math that you want, but the human element will always add a form of unpredictability and irrationality to the market. Now look at this chart from JP Morgan. It shows the 20-year annualized returns by asset class from 1999 to 2019. As you can see, REITs performed best, then gold, then the S&P 500, and so on. But look all the way to the right. The average investor underperformed all asset classes over this period, including inflation. But how is this possible? It's because the average investor reacts emotionally and buys at market highs and sells at market lows. This video actually has a lot of similarities to the points I was making in another recent video about compound interest. I'll link that video at the top if you're interested in viewing it. But I wanted to get this video out today because the month just ended and the S&P 500 was up 12.68% for April. This represents the best monthly gain since 1987. Here's the S&P 500 monthly performance for the year so far. In January, it was down 0.16%, February it was down 8.41%, in March it was down 12.51%, and then, like I said, this past April, it was up 12.68%. So for year-to-date 2020, the market is down 9.02%. Based on what's been going on with the virus and everything we've seen in media headlines, you'd think that the market was down more than 9%. But in reality, that's what it is, and it's not as bad as we think. Now imagine that after the market declined to start the year, you got scared or you thought the market had further to fall, and you decided to sell out of some or all of your equity positions. Then you missed out on all of the upside of the best month in 33 years. At this point, you may be telling yourself that it's all a bull trap and the markets have further to fall. But what if you're wrong and the markets continue to recover? This is what makes timing the market so hard. At what point do you admit defeat and jump back in? Or how long do you hold on to your belief that the markets will fall further? Part of what makes timing the market so tough is that you have to be right twice. You have to be right on the way out, so you have to pick the peak. If you're a little early on that, then you'll miss some of the run up and potentially not get the full benefit of trying to time the market. And if you go too late, then you'll already experience some of the downside, and that makes it really tough to decide when to get out. But then you'll also have to be right a second time when to get back in. You have to time the market bottom. And that's also really difficult to do. If you're early there, then you'll still experience more downside. If you're late, then you may miss the majority of the run-up. So basically, to fully cash in on the strategy of market timing, you have to be right in the market top and the market bottom. What also makes this really tough, as recent market performance has shown us, is that the biggest down days in the market are often very close to the biggest up days in the market. So if you react to poor performance and sell out of the market, then it's very likely that you might miss some of the best days in the market following that period. The majority of market performance is actually realized in just a few of the best performing days. This chart shows the effect of missing those best days. The left bar is the performance of the S&P 500 from 1990 to 2019. If you had invested $1,000 and left it for the entire 29-year period, you would have $17,273 today. But if you missed just the single best day of performance over that period, then as you can see in the second bar, you lost almost $2,000 of your performance. You would only have $15,480. If you missed the 5 best days, then you'd only have $11,459. And this continues until if you miss the 25 best days, then you only have $4,313, which is only slightly better than investing in 1-month UST bills. There are 10,585 days in a 29-year period. Well, I guess actually a few more if you include leap year. But if you missed the 25 best days, then you lost almost the entire advantage of investing in equities. And I hear you, everyone feels the temptation to try to time the market. It's human nature to try to be cleverer than everyone else. Psychologically, this is known as hindsight bias, which is the idea that I knew it all along. People tend to look at past events and say to themselves, all the signs were there. I should have seen that coming. It was so obvious. Hindsight bias can be expensive when you use it to try and time the markets. When we look at past events and we say that was predictable, I should have known that was about to happen, the next logical step is then to try and predict the future. There are always technical and market indicators to buy as well as to sell in the market. So you can look back and only choose to look at the ones that indicate what actually happened. This helps to make it much more difficult to predict future performance than hindsight bias would lead you to believe. Let's look at a little experiment. We have a fictional investor, Jackie. She is a buy and hold investor with the worst timing in history. Jackie invested $50,000 in the S&P 500 at the peak of the market just before each of the 4 worst market crashes of the last 50 years. So her first investment was $50,000 in December 1972. This is just before a 48% crash. Her second investment was $50,000 in August 1987, just before a 34% crash. Her third investment was $50,000 in December 1989, just before a 49% crash. And her fourth and final investment was $50,000 in October 2007, just before a 52% crash. Even though she had terrible timing, Jackie never sold and let her dividends automatically reinvest. By May of 2019, her 4 investments had grown to $3,894,503. Not bad considering she only invested $200,000 and invested the 4 worst times in the last 50 years. So as this example shows, you can still be a very successful investor even if you invest at the absolute worst times, as long as you don't react to downturns in the market. Still not convinced? Well, I suggest you try a little experiment then. But let's do it with fake money rather than real money. Let's make some predictions. Will the stock market finish higher or lower at the end of the year than it is right now? How about in 90 days? What will happen with real estate in your neighborhood over the next 5 years? Where will interest rates be in 90 days, 100 days, or a year from now? What about the value of a share of Apple in 6 months? Then keep track and see how you do. If you're like most of us and you're honest with yourself, then you'll quickly realize that you really have no idea what the future holds. Even if you're right about few things, I think you'll come to realize that it was more luck rather than skill in coming with those right predictions. Another downside to trying to time the market that people don't really think about is that a lot of the stock market appreciation is actually due to their dividends. Between 1930 and 2018, dividends actually accounted for 43% of the total S&P 500 performance. And when it comes to compounding and dividend reinvestment, they actually play an even more important role. Since 1960, they actually made up 82% of the total return of the S&P 500 when you take into account dividend reinvesting and compounding. When you're sitting on the sidelines trying to time the market, you don't receive these dividends, and that can really hold you back. Now I'll leave you with a quote from Benjamin Graham. He's considered the father of value investing, and he said, "If I've noticed anything over these 60 years on Wall Street, it is that people do not succeed in forecasting what's going to happen to the stock market." Now before I go, let's do a little experiment of our own. How do you think the S&P 500 will perform in the month of May? And also, how do you think it'll perform in 2020 in general? Then let's look back at the end of the year and see who was closest or laugh at how far away we all were. If you like this video, please hit the like button and subscribe, and also hit the little bell icon so you don't miss any future videos. Thanks for watching. Bye.